This is Matthew Cratter from Trader University, and today I want to answer the question, is the Fed trying to crash stocks? This is a question I've been getting from many of you over the past few days. What we have, the situation we have in the US and really globally, is we have this everything bubble that's been caused by very accommodative Fed policy for the past decade. And a lot of people have compared it to almost like a heroin addiction for the financial markets. They're so dependent on Fed money printing and low interest rates. And the way this works is this: when you have more liquidity, it's very good for risk assets. Risk assets like stocks, corporate bonds, Bitcoin, etc. We're going to talk about Bitcoin. Bitcoin is not really technically, in my opinion, a risk asset. It's actually the risk-free reserve asset. So the market's currently misunderstanding it, but it has been moving as a risk asset. It's been highly correlated to stocks, as we'll talk about later in this video. And I would say that this can appear problematic, but what it really is a sign of how early we are, that the market doesn't understand that this is actually the risk-free asset that can't be inflated, it can't be confiscated, etc. But for now, Bitcoin really does trade like a risk asset. So it sells off as bonds and stocks and commodities, etc., sell off. So this is how liquidity and risk assets work together. The more liquidity, the more dovish Fed policy, in other words, the lower interest rates and the more money printing, you get higher asset prices. Low interest rates means you get higher PEs, etc. So for the same amount of earnings, you get a higher stock price when you have a higher PE attached to the market or to the stock. And then the converse is true. Less liquidity is a more hawkish Fed policy, higher interest rates, less money printing. This naturally leads to lower asset prices. And as we said, Bitcoin really is its own thing. But for now, it trades like a risk asset. We've already been seeing signs of this liquidity tide going out. We had the big Facebook plunge overnight. We had the big PayPal plunge the day before. Now these, obviously there's company-specific explanations for each of these, but these are not the kind of moves that you see. The size of these moves are much more reminiscent of a bear market than a bull market. And I wouldn't quite go as far as saying we're in a bear market right now. I would say we're more in a hawkish Fed regime. But these kind of moves, even though they have company-specific drivers, the moves are exaggerated by the tide of liquidity receding. Now, what a lot of people have been saying, I've especially been seeing this on Twitter, is look what's already happening, and the Fed hasn't even raised interest rates once. This is really scary. But what people don't understand when they say something like this is that, as I say many times, the Fed talking, in other words, jawboning, more hawkish policy, jawboning rates higher, the Fed talking is Fed tightening, is the Fed becoming more hawkish, simply because the markets are always forward-looking, and they're always trying to price in the probability of something before it even happens. If it's a low probability, it doesn't get quite priced in as much. If the market thinks it's a very high probability, it starts to get priced in. So we've already seen the whole interest rate curve, the euro-dollar curve, Fed funds, etc. These adjustments have already happened. And so in many ways, the tightening has already happened, even though we're not in March and the Fed hasn't technically raised rates a quarter percentage point or half a percentage point, but a lot of this is getting priced in. So the damage is already occurring. This is something we've been talking about since December 4th, when I first noted on this channel how the Fed had reversed their rhetoric and what this meant for risk assets over the coming months. And while I'm here, I would just ask you, if you're finding this video helpful so far, to be sure to hit that subscribe and like button. Maybe share this video with a few friends who are interested in Fed policy, Bitcoin, and what's going to happen with the stock market. Now, Bitcoin really is the canary in the coal mine. This is not meant to imply that anything bad is going to happen to Bitcoin, but Bitcoin is a very free market. It's a very liquid market, and it really has been range-bound since, call it February or March of 2021. We've had some volatility surrounding China kicking out the Bitcoin miners, so we've had some big lows, and we also made some marginal new highs back in late October, early November. But Bitcoin really has been range-bound in this period of tighter liquidity. And this is true for growth stocks. This is true for the riskiest stocks, like the kind that ARK holds, ARKK. ARK peaked in February of 2021 and has really been making lower highs and lower lows. Since then, we've also seen the same thing happen to all the meme stocks. Obviously, these are the real sensitive indicators to liquidity. We had all that craziness in the beginning of 2021. I certainly would not want to be holding any meme stocks in an environment of Fed tightening. Things. This goes for altcoins as well. This is actually a fascinating chart of Doge, and it shows what's happened since. This isn't just a function of Fed tightening, but this is also what has happened since Coinbase listed it. So this is Doge versus US dollar on Coinbase, and it's been straight down since June when it was listed. So be very careful buying new listings on Coinbase as well. This is another way that garbage gets dumped. So this is really a mixture of Doge being basically worthless and no longer being propped up by Fed liquidity. There are a lot of charts going around. This is a correlation chart of Bitcoin versus non-profitable tech, which you might, there's a huge overlap there with Cathie Wood's holdings at ARK. And we can see really since late 2019, early 2020, the correlation of Bitcoin with tech stocks, with the riskiest tech stocks, has been quite high. Correlation goes from -1 to +1. The closer you are to +1, the more the short-term correlations, the higher the short-term correlations are, which means they tend to move together. And then they don't have to have the same magnitude moving together. But this correlation has existed. And I would say a lot of it is a function of institutional adoption of Bitcoin. The more institutions hold Bitcoin, the more it will move in sync, at least over the short term. And again, these are short-term correlations. The more it will move in sync with stocks as portfolios, as institutions. If they trim down their portfolios because they feel they have too much risk, they will sell off the most volatile, most liquid stuff, and Bitcoin is certainly in that category. And I would say the other reason you've had these high correlations is that the whole market, the stocks, junk bonds, Bitcoin, altcoins, etc., meme stocks have become very sensitive to Fed policy, and the Fed really has become the only actor in the room that matters. And so you have these things moving together, and you have less what you might call dispersion than you used to have before 2020. NYDIG did a great version of this as well, showing how correlated Bitcoin has been with, I think this is with stocks and with risk assets, been very, very correlated. We can see that from 2011 to 2020, the correlations were mildly positive or mildly negative. They got as high as 0.2, 0.3, or 0.4. And now they've stayed really at an elevated level, as NYDIG points out. And again, this is really a function of everything being driven by Fed liquidity. So back in March of 2020, when we had that crash, as the pandemic was getting started, Bitcoin fell from about 10,000 down to about 4,000. S&P fell from 3,300 down to 2,200. And this is just to show you that correlation, short-term correlation, doesn't necessarily determine long-term returns. Since those lows, Bitcoin, as of today, obviously it was much higher a few months ago, but as of today, Bitcoin is still up 9 times from the lows. S&P is only up 2x from those March 2020 lows. And so short-term correlations do not determine long-term returns. And as I said, people are going to figure out one of these days that Bitcoin is not a multinational corporation that has shareholders, that has a market cap, that has a board of directors, that has cash flows, etc. It's absolutely absurd to put Bitcoin in the same package, in the same bucket as the S&P 500. And a lot of people, I always see this in the comments, Bitcoin is just levered tech, and it has behaved that way. This is a little bit like saying Pets.com and Amazon are the same thing, because in the late 90s and early 2000s, they always moved together. But now we know that Pets.com is long gone and Amazon is still around. So short-term correlations tell you nothing about long-term results. Bitcoin probably will stay fairly correlated with risk assets for the time being, but there is going to be a point when it breaks away. And when that happens, when that repricing happens, you better not be on the sidelines in Bitcoin, because it could be extremely violent as people begin to realize that Bitcoin really is the only safe haven out there. Treasuries are not a safe haven. They don't protect against inflation. They're constantly being diluted. So to get back to the question, is the Fed trying to crash the stock market? Absolutely not. They do not want to crash risk asset prices. Bitcoin, they're not trying to crash Bitcoin either. Bitcoin, the attack is on the regulatory front and will take different forms. But they're not, interest rate policy is not being driven by Bitcoin at this point. It's still a very small market. It's not really, Fed governors don't understand it. It's barely on their radar at all, even though it is on regulators' radar. The big thing that the Fed has to look out for is federal tax revenue here, which is total tax revenue in the U.S. We have this problem, as I'm always pointing out, that the U.S. government, the federal government spent in the last 12 months spent $7 trillion and only brought in $4 trillion. So there's this budget deficit which has to be financed by issuing more debt. If the Fed crashes the stock market, tax revenues plummet, which they do not want. That being said, the Fed does want to put a lid on inflation temporarily for political reasons. The Biden team is getting pretty stressed about midterms and pretty stressed about these high grocery prices, high rent prices, high gas prices. And these are issues that really matter to voters. The Fed does not want to crash asset prices, stock prices, housing prices, as I said, simply because lower stock and housing prices means everyone has lower profits, lower paper gains, lower real gains, and as a result, they pay less in capital gains taxes. The government has less revenue, and a huge percentage of government revenue is from capital gains. Also, lower asset prices means much less consumer spending, which is still a huge percentage of the economy, and hence lower GDP. The Fed's ultimate goal, what they're trying to do is they actually do want inflation. They want the GDP, they want the U.S. economy to grow at a much faster rate than debt. And the only way the Fed can do this is by engineering the inflation the inflation bit of GDP. So GDP, you have nominal GDP, which is comprised of real GDP plus inflation. The only way you grow real GDP is by having entrepreneurs, by having inventors, by creating nuclear fusion, etc., by having tech innovation. The only thing the Fed can do, because they're a bunch of empty suits, a bunch of former investment bankers and lawyers, etc., is they can play with the inflation piece. They need to bring debt as a percentage of GDP way down. And the only way they can do this is by having less debt, which they can't do because the U.S. government is not going to stop spending. But they can inflate GDP by allowing inflation to run hot. And we can see here that over the past 18 months, call it, the debt to GDP level has moved down from 135% to 122, 123%. And this is with the Syrian hot inflation that we've already had, CPI inflation of 7% and actual inflation probably much higher. It's only brought GDP down from 135 to 122. We need to get it back more to the levels it was in the 90s or even early 2000s, around 60, 70, 80%. So this is what the Fed is working on. When debt is a much smaller percentage of GDP, they will be able to raise interest rates a lot more without blowing stuff up. When you have a lot of debt versus the actual output of the economy or the productive output of the productive size of the economy, it's very hard to raise rates without blowing up the economy as well. So the Fed really has to try to ride. It's like it's on horses trying to ride in two separate directions, trying to inflate our way out of the debt and make the Biden administration happy as well in the short term by pretending to fight inflation, even though they want long-term inflation. I mean, this is the system we live in. When you say these words, you can't even believe it. It's so absurd. But at the same time, they're trying to inflate our way out and make Biden happy in the short term. They're also watching markets like the junk bond market. This is HYG, the high yield bonds, which have been selling off pretty sharply. They'll be keeping an eye on this. They'll be keeping an eye on stocks as well, and seeing how much they can tighten temporarily without blowing things up. You would not want to be in the Fed's shoes today, because they need to inflate us out of our debts and somehow not spook the Treasury market. If they spook the Treasury market and interest rates move higher, the government will have a much more difficult time financing itself, and the Fed will need to step in. It also doesn't want to spook any of the corporate bond markets, whether the junk market or the regular corporate bond market. It doesn't want to spook the stock market either. They do not want to crash the stock market. They do not care about valuations, except to the extent that the stock market has become a tail that wags the dog. But they need the stock market to continue to go up in order to finance budget deficits through keeping capital gains high. So the Fed, they want inflation long term. They don't want inflation short term. When they're tightening, as they are now, and being more hawkish, risk assets are collateral damage. They want to bring inflation down, but at least temporarily, they don't want to crash the stock market. But the stock market is beginning to be collateral damage. So you can be sure they have one eye on Facebook and one eye on PayPal, one eye on tech stocks, etc., one eye on the junk bond market. You can expect the Fed to rush from one side of the boat to the other, from the dovish side to the hawkish side, and back again many times this decade, because they have so many constituents here that they are playing to. I would say that what is happening today is the Fed is actually flirting with a recession here. They are making a huge policy mistake, in my opinion, and they are watching they're watching what's happening. If you're a Facebook or PayPal employee, your discretionary spending ability just got hammered. All your stock options are now deep out of the money, and the problem with having such a levered economy is you can go from a booming economy where things are red hot and everyone's feeling really good and asset prices are going up even though there's inflation, and you get a little too much tightening, you get a few too many crashes in various tech stocks that have a huge influence on the economy, and you end up with a recession. If we start to get close to recession, and there are a lot of economic signs, a lot of indicators that the economy is slowing down, the Fed is going to need to turn back on the money printer. So that's where we are. The Fed does not want to crash the stock market. Stock market is collateral damage, but at a certain point, if the stock market declines enough to really slow down the economy, the Fed will cry uncle and will be forced to turn back on the money printer. So I remain very bullish on stocks for this decade, extremely, extremely bullish on Bitcoin as this very special, unique asset for the next 10 years. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.